Hey, Trader Stephen here with TradersPlane.com. It is Friday, December 31st, final day of the year. Whew, it's crazy. It's already gone. We're going to look at the market real quick, and we're going to look at top ETFs of the week, and then we're going to also look at some of the top ETFs of the year and kind of see if we can learn anything. Some really big trends this year. I know as of lately, even though we're looking at the S&P 500, the S&P 500 actually looks pretty good, right? But from kind of a swing trading standpoint, it doesn't feel very good at times because the Nasdaq is underperforming. A lot of the growth stocks are kind of really still in their trading range, even though this is really at all-time high. So it's impossible to be bearish at this moment. But the Nasdaq is lagging, so eventually those two are going to have to come together. But right now the S&P 500 looks good. It had a little double bottom, breakout, all-time high, and hopefully we'll finish on a positive note today and kind of at least make us feel warm and fuzzy, at least heading into the weekend and in the new year. But the Nasdaq is lagging right here, and this is kind of what I was talking about. Now, you had a nice little breakout on Monday, right? You got a double bottom right there. That looks good. You have a breakout. It's just been easing a little bit. Volume's been low, so to me, the few-day pullback is not a big deal. If it can break back above Monday's high, I think it's going to hit fresh highs, but it's in the middle of this right now, so we'll just kind of have to wait and see. Hopefully this catches up instead of the S&P 500 coming down. I don't really like to see it when they are too far apart. Sometimes they are a little bit apart just based on money rotation, value versus growth, but I don't like seeing them too far apart, and we'll kind of have to wait and see. But I'm hoping the Nasdaq catches up. So let's look at the S&P 5, or excuse me, the SP, the top ETFs of the week list, and let's start with the top ETFs of the week, and then let's go to the top ETFs of the year. Let's start with this one, and the funny thing is this Crane Shares Global Carbon. This is the #1 ETF of the year also, but it's gotten pretty crazy a little bit. It's up 103% this year, 5% this week. It pulled back, and then it got close to the 50-day moving average and bounced. Honestly, I don't know how I feel about this. This is probably not my cup of tea. You could say it's kind of it could break out of this, and then that would be a buy. But to me, this could really be an exhaustion. But at the very least, I think it's more forming a pattern, and I think based on this exhaustion or this move from 38 to 54, I think it needs a little bit of time to go sideways, consolidate before probably it's something for me. But you might want to buy this breakout above 51, something like that. That might be a good breakout, and it might work. A lot of these charts kind of look like crap, like Cocoa, Brazil. That really is in a downtrend, so we're not going to focus on the laggards. But what is interesting is oil now, and you have also this really double bottom type of formation. You get the breakout of that pivot, and now it's back above the 50-day moving average, which is the orange line. So honestly, given the volatility of oil that is around the COVID, right? The direct correlation, right? The scarier it gets, oil just absolutely sells off, even more so than the indexes. I'm probably not going to play a lot of oil at the moment until some things settle down, just because you have like one day right here where this was down 11%, just boom, got hit on bad news. Now it's up, so I think we need to be open to the fact that oil could hang in there. So I guess my line is saying is if it rolls back over, right, if it holds this 50-day moving average for maybe another week, then I'm definitely open to considering, especially as states are hitting all-time highs with their numbers. I know Arkansas hit a record all-time high yesterday, so I assume most states are following suit. So if it can hold this 50-day moving average, I'll be more open to energy. But I think if the cases continue to get high and the market doesn't like it, this is going to sell off the hardest. So I think this has the most risk, in my opinion, to a downside sell-off, just based on what we've seen right here, what we've seen last year. So be a little bit cautious. This iShares Wood, WOOD, is looking pretty good in my opinion. I love the fact that it's been consolidating since April, and it's got a nice, really sideways consolidation, and it's starting to wake up. If it breaks above this 92 level, and this could just be kind of an inflationary play, excuse me, I've seen the price of lumber is back above 1100 based on their measurement. So, you know, it went from 1900 down to 600 back up to 1100. So it's rising again. I would say that if this, and this made a monster move and it needs time to consolidate. So if this breaks back above 92, kind of this level, I would definitely consider a trade with just a stop under here. This is, yeah, I'll actually probably put that on my short list because that's looking pretty good. So, and the reason why I like these long consolidations and then all of a sudden a breakout, because the longer the base, the higher in space. So when the stock or an ETF, doesn't matter, makes a big move and then it consolidates for a long time, then it starts to wake up again, right? Wake up again, starting to wake up. That really piques my interest because it's done consolidating, right? It really wore everybody out along the way right here. So I'm a lot more interested after it, you know, frustrates everybody, because then everybody doesn't want to have anything to do with it, and then boom, it takes off and it leaves everybody behind. There is, you're noticing some REITs. Look at these REITs. You got U.S. Real Estate, IYR. This is looking like a very strong. REITs are really been piquing my interest, and then they started to take off this week. The reason REITs have been piquing my interest, and I really like some of the individual residential REITs, individual stocks. Whoops, that was a bad draw. My mouse, I hate this mouse. But you know, it kind of looks like an inverse Head and Shoulders right there, and then it's breaking out and it's starting to accelerate to the upside. So that's pretty interesting, and I'll make the fundamental case for why residential REITs are probably so an area worth looking at, is because the U.S. market, as far as builders and individual buyers, have kind of hit their wall, how much they're willing to pay for new construction. I read a report out. What that means is if they're not willing to pay, you know, any more than what they're paying right now, or they're you know, home building sales have declined or starting to decline, that's going to increase demand for rentals. That's going to, you know, continue to probably eat up the supply. Now, I don't think that's going to lower the cost of housing, right? Because there's still going to be a shortage of houses, but I think that's going to create the shortage of REITs, and they can raise their prices on the residential side. And so far, that theory is looking to hold a little bit. Last couple weeks, like, it's starting to take off. So if I do like one area right now where I'd say, hey, one area, I would probably look at these REITs. They have been consolidating a while. You have the pattern, and you can just have a nice stop loss kind of under this level right here, under the 50-day moving average, which is about 92.85 right there. So you can put a stop loss at 92.50. Right, and see it's starting now. These REITs are not exciting. Let me be clear. They're not going to take off like cannabis stocks. They are nice, boring uptrends, but you might appreciate a nice, boring uptrend if the market, the first quarter is a little frustrating. Right, I like nice, boring uptrends. So here we go. You got the REITs. Now, what else? All right, so really, that's really what I want to show you of the week. Now let's look at of the year. I think it's very important, and I really hope and I really pray that now that everybody is at the end of the year, and I've been spending all week prepping, you know, looking at trading systems, looking at what I did wrong. It's way more important to focus on what you did wrong versus what you did right, so you can learn from them, so you can put reasonable rules in place to avoid them, right, in the future. Like, you know, did you start a trading a system and you took a couple losses, and did you abandon that immediately, right? You know, that's probably a very common. Or did you start a set of rules and it didn't start off very well, and then you abandon it? Well, if you research whatever rules you're going to put in place, all right, and it has stood the test of time. Even if you have a bad stretch, I think it's important to really stick with something for 20 trades, because 20 trades, you have winning streaks, you have losing streaks, and that really helps you check your emotions, right? How did you feel during the win streaks? How did you feel during the losing streaks? And then you can adjust from there. So I kind of have a 20 trade rule. So let's look at the top ETFs of the year. You have global carbon, which we already talked about. It's getting a little extended, probably not for me, but it does have, in my opinion, a nice bullish pattern, but I personally think it needs to do this for a while. You have a lot of commodities. Let's just look at the list. You got nat gas, oil, coffee, uranium, which this is starting to look like crap. Energy, construction. Construction is actually the one, and this chart actually looks nice and neat. It's not as volatile, but you have home construction that is still looking pretty strong, almost at all-time highs. Even though I talked about the report, right, that doesn't mean construction companies can't make money. So you have this ETF right here, and honestly, I don't know how I feel about it. It doesn't excite me, I'll put it that way, right? I would rather look at some individual stocks in this ETF right here. But let's just kind of go through these, right? You have FCG. So you have this ETF that went from $8 to $17 this year. Now, here's what's important. If you look at this chart, it actually, if you bought and hold, yeah, that's fine. You're probably pretty happy, but it looks pretty frustrating because there is nothing smooth about it, right? You have some 18% decline right here. You have a 29% decline right here. You have a 20% decline right here. But I'm going to be honest with you, that to make any move, and this is kind of a lesson that I learned, to make any reasonable move, you're going to have to sit through some pullbacks, right? And you can have rules. Right? On this one, like you could have had a rule like, hey, I'm going to sell half, I'm going to buy, and I'm going to sell half when it breaks the 50-day moving average right there. And then I'm going to sell half when it breaks the 200-day moving average. And the other half when it breaks the 200-day moving average. If you believe in the long-term theme, and these two bars right here, this 200-day moving average never broke. So you'd still be half in, right? And that's only a rules if you believe in long-term themes, right? So you can use the long-term moving, and the moving averages aren't the end-all be-all. Let me be clear. They're just a tool. They're just a tool that's easy to plot on a chart that's not too fancy. So FCG, it's consolidating. I don't know. Again, for energy, I have a little bit more of a cautious stance. But if it breaks out, then I would definitely be more open to it. IEO probably looks of similar in nature as it does. Look, you got the same pullbacks, same consolidations below the 50-day moving average, but it was up 70% this year. Okay, now we are in an inflationary environment. Everybody knows that. That is not new, but that does not mean that you should just buy and hold commodities. Just start picking commodities and they're going to go up every year for the next 5 to 6 years. If commodities were super strong this year, they might underperform next year and then retake the leadership later on in the year. I don't know, but I need you to understand, don't chase something just because it did good last year, right? Because we're going to look in a second. What was worse? What was the best last year? Like in 2020 is actually the worst this year. We're going to look at some of those. So I'm teaching you this lesson to caution you on just jumping on the bandwagon and expecting riches. All right, so you have the USO. We've already looked at that. Coffee is up, right? But again, commodities are in credit from 35 to that, but it's not a straight line, right? There's a lot of emotions involved in this, okay? So you have uranium, which I did have. It made a really, really nice move from this level to this level, and especially up to here, but not everything lasts. That's why you want to have rules. And even look at this. This went from 50 to 98. This doubled in about a month. That's kind of crazy. And it just could not, and it created a nice cup with handle right there, breakout, and then it just absolutely failed and is now about to break the 200-day moving average. So very, very strong this year, even though as of lately it's way off its high. But that is what it is. So you have more energy, more home construction. You can kind of see a theme here, right? A lot of commodities were very, very strong, and you can see their performance. So what I like to do a lot of times when you have commodities like this, okay, I say, okay, what U.S. Stock industries are outperforming? And semiconductors is had a very, very nice year. Does that mean that they're gonna have a good 2022? No, it doesn't. It had, it broke to all-time highs on Monday. It's kind of a slow grind higher, right? This is not nice and neat like REITs. This is chopping all over the place. But I think there can be some money in made in semiconductors. I tend to not believe that this is over. I think that we are just on the cusp of needing these chips for everything that this world needs. Could they use a deeper correction? Sure, but semiconductors had a really, really good outperforming year last year. Now let's take a trip down memory lane and let's look at. I got to go to the weekly chart. Let's look at what sucked the most this year. China, this Chinese ETF, and I'm going to be honest with you, I'm done with Chinese stocks. And the reason I'm done with Chinese stocks is it's not because of this downtrend. This downtrend could easily turn around. It's more of the regulation, right? I think a lot of them are going to move over to Hong Kong. I think that China snaps their fingers and can just change something. I think they're going to have to match our level of accounting, which could change things. I just think there's so much regulatory risk right now with Chinese ADRs. It's just not worth the upside. I'd rather find some other hot shot industry that can go to the moon versus having all this regulatory risk. But man, this ETF was at 100 earlier this year. It had a very, very nice year last year, and then went all the way down to 34 this week. So even though it had a really, really strong day yesterday, so it's just chop you up and spit you out kind of stuff. And this was probably June, March. I wouldn't say it might have been one of the biggest winners. Maybe, maybe not. But I mean, it had a good year, right, from here to here in 2020. And then look at it. Old cannabis stocks. I swear there is going to be a day where they make money, but they deserve it, in my opinion, and they deserve it because they do not make money. Most of the cannabis, at least growers, I think that there are some cannabis companies, like Grow Generation, that actually turn a profit, and some others, but they just are not profitable. And there was so much hype. Let's kind of look at this. I made so much money off cannabis stocks last year, and I mean there was such a move. I mean, look at this, from 7 to 29 bucks. That is a ETF, and that happened over a 4 to 5 month period. So you have a 4x move in an ETF, and now it's lower than what it was. And all this hype happened. Expectations of Biden winning the election, and look, like the very first week in February when he actually took office, it's been downhill ever since, right? Buy the rumor, sell the news. So, getting elected, taking office, nothing has happened. So clearly this is more news driven than some of the others, but this has been a horrible year, and this is a horrible downtrend. And I've tried to trade a bounce a couple times, and it just never work. Now, there will be a time where they do make a rally, and I don't know what it's going to take. I really don't. I mean, it might take legislation, which I don't see happening, especially the 2022 midterms if the Republicans take over. I don't see it happening. Maybe it does, or maybe it takes actual profitability, because that's what the stock market is all about, which stocks are making money. But this one looks pretty rough. So you went from having the best year to having the worst year. Now, I'm showing you this to say it could have a good 2022, right? Well, everything I just said should be meaningless. It is an opinion, right? I don't know. If it starts to technically break out, I am all on board. But until then, it's in a downtrend, right? I'm not going to catch a falling knife. Let's look at what else has been awful This is more of a China ETF right here. So you got cannabis, you got China, clean energy, right? You got some clean energy right here. Look, also look at peaked, the same time cannabis did, right? You had all this hype, right? And you had an acceleration to the upside, right? From 52 to 138. That's not a stock, that's an ETF. And then it hasn't done jack diddly squat ever since, right? It is in a monster consolidation. I at least have more hope for this industry than I do the cannabis industry, because I don't think you need a ton of regulation for these guys to start making money. You just need innovation, but it's going nowhere fast. So until I see some major technical hurdles, but again, this could be the industry of 2022. You don't know. This cannabis and clean energy, it clearly led the way in 2020. It clearly led the way to the downside in 2022. Does that mean they're going to be the best? I don't know, but just wait for some kind of technical event to happen. So, and the goal of this exercise is to show you, hey, just because something's hot, just because carbon is hot this year does not going to mean it's going to go to the moon next year. It could be the worst, absolutely worst performing industry, and that's, I think we've seen evidence of that. So, what to do now, right? I'm definitely working today. I've been working all week on, really planning out my 2022, planning out my trade plan, planning how I'm going to help my customers and my students in the best way that I possibly can. But at the end of the day, I think it's important that we all have a set of rules in place to keep us grounded, help us make a lot of money on the upside, and at the very what's more important is protect us from losing money on the downside. Because the reality is I can't control which stock is going to go up a lot, right? Anyone who says they know, they're just full of crap. But I can control how much I lose on losing trades, right? When I buy a stock, it's going to do what it's going to do, right? No way to control it, but I can control how much I lose to the downside. That way, if you have a rough couple trades, a rough quarter, rough month, whatever, you can live to invest another day. So I wish everybody a happy new year, and I will see you in 2022.